In June 2020, the Indian government banned over 300 Chinese apps, including TikTok. These bans targeted the visible presence of foreign digital influence in the Indian market. During that exact same month, Japan increased its position in the Indian economy. Without public fanfare, Japanese firms acquired stakes in banking, IT, logistics, and major tech unicorns like Flipkart and Swiggy. Japan is now India's fourth largest contributor of foreign direct investment. Over the last few years, this capital flow has multiplied 11 times over, embedding Japanese finance into the country's strategic infrastructure. While these billions drive rapid growth, the sheer volume of the influx raises a difficult question. Is this an economic partnership or a gradual shift toward foreign control of India's most critical sectors? To understand the risks of such a massive influx, economists look back at Indonesia in the early 1990s. At the time, Indonesia shared several traits with modern India: a fast-growing economy, a massive young population, and a heavy reliance on foreign capital to fund its expansion. This chart shows the collapse of the Indonesian rupiah in 1997. When regional risks emerged, foreign investors pulled their capital immediately. In just a few months, the currency's value plummeted by 80%. The resulting crisis destroyed the country's purchasing power. Inflation hit 65%, thousands of businesses closed, and the sudden economic vacuum triggered violent nationwide riots. Indonesia's experience highlights a persistent economic vulnerability. When a nation relies too heavily on external capital for its growth, it risks a sudden total collapse if those investors decide to leave. Japan's current strategy in India is driven by its own domestic crisis. In the 1990s, Japan's massive economic bubble burst, leading to 3 decades of stagnation. This diagram illustrates Japan's long-term deflationary trap. When prices fall, consumers wait for lower prices before spending. This delays revenue, squeezes profits, and freezes wages, making the stagnation self-reinforcing. This cycle is worsened by Japan's demographic shift. As the consumer base shrinks every year, the demand needed to break this loop disappears. Currently, 30% of Japan's population is over the age of 65. With a shrinking workforce and a declining birth rate, domestic investment opportunities have effectively stalled. Despite this stagnation, Japan maintains a high savings rate, with nearly 30% of its wealth sitting in the system. The problem is that there are no profitable projects within Japan to absorb this excess cash. For Japan, exporting capital is a matter of survival. Keeping this money at home offers zero return, forcing Japanese investors to find markets where growth is still possible. India provides the exact opposite conditions. Where Japan is shrinking, India is expanding, with 65% of its population under the age of 35. By 2030, an additional 100 million people are expected to enter India's middle class. This demographic shift represents a massive increase in domestic spending and aspirational demand. This growing population requires physical assets on a massive scale. To sustain this trajectory, India needs new housing, modernized power grids, and high-speed transit systems. This creates a direct structural alignment. Japan has a surplus of idle capital, and India has an urgent long-term demand for it. Geography is the final factor pushing Japan toward India. Japan's security environment has become increasingly difficult due to tensions with China. Tensions are concentrated around the Senkaku Islands. In 2024 alone, Chinese Coast Guard vessels entered these Japanese-controlled waters dozens of times, keeping the region in a state of constant friction. Japan is currently dependent on China for both imports and manufacturing supply chains. This makes the Japanese economy vulnerable to sudden Chinese trade restrictions or raw material bans. Japan is now actively incentivizing its companies to relocate production from China to India and Southeast Asia. This shift is a strategic effort to decouple their economy from a neighbor they view as a risk. While the fear of an Indonesia-style collapse is a common concern, the actual structure of India's debt to Japan suggests a different outcome. Indonesia's crisis was triggered by borrowing in US dollars while earning in local currency. India's loans from Japan are issued in yen. Since the yen has consistently weakened against the rupee, the cost of repaying these loans has actually decreased over time. Furthermore, Japanese investment is focused on physical infrastructure rather than volatile stock market bets. Japan is funding the Delhi Metro, high-speed rail, and battery manufacturing plants. assets that cannot be easily liquidated or withdrawn. This focus on fixed, long-term assets means the risk of a sudden capital flight, the very thing that destroyed Indonesia, is significantly lower in the India-Japan relationship. The primary threat to India's future is not foreign control, but internal inefficiencies that prevent this capital from reaching its full potential. India faces severe internal friction. Complicated regulatory approvals, land acquisition disputes, and aging logistics networks create delays that inflate the cost of every major project. There is also a significant skill gap. While India has a massive youth population, a large percentage lacks the technical training required to operate modern, high-precision manufacturing systems. Countries like Vietnam and Singapore avoided this trap by aggressively removing regulatory friction and aligning their education systems with industrial needs, allowing them to turn foreign investment into massive export growth. Japan is providing the funding and the technical knowledge India needs to expand. But if India does not remove its internal bottlenecks, it will remain a market for foreign goods, rather than becoming an independent production power.